What if I tell you that a trading range is actually all you need in trading? In this video, I'll give you a full trading plan just based on ranges, as well as different ways to trade them, and make sure to watch the video till the end, as I'll give you a free indicator that will help you with the trading plan. Let's get into it. Now, because the whole trading plan is based on ranges, we need to understand what a range is. And there is no specific condition for a range. It can be, just one candle, because if this is a daily candle, then in the lower time frame, it's going to be a lot of highs and lows being inside of a range, which is the daily candle. So you see, this daily candle with a high and a low can be a range. We can also consider a range by two lows and a high, or just a low and a high, or maybe two highs and a low. So different ranges, but we're gonna go over this later, and I'll give you the indicator that will help you with this. And we're gonna trade with different ranges, so it's not going to be a hard job for you. Now, we can also consider a range by multiple highs and lows inside of each other. So you see, we have high, we have a low here, another low, another high, another low, another high. As long as those highs and lows being inside of another high and low, then that's a trading range, because we are being inside of this range for some time. Highs and lows inside of other highs and lows, that's a trading range. So you're gonna know when we go over the example that we can have different types of ranges, and all of this will be easy when you get the experience. So when you train your eyes looking at different ranges, you're going to know which one is valid and which one is not. So that's going to be your job. It's all about experience. Now, we got to also understand that in any trading range, two things are going to happen. Now, sometime one of them is going to happen, and sometime two of them at the same time. So we can have, in a trading range, we can just see a manipulation, right? So we can see a manipulation happening, which is price, given a false breakout in one direction, and then whatever happened after, it doesn't really matter, but we're focusing on the manipulation. So we can actually trade this and then maybe take profit at 50% of the range, right? So manipulation here, we enter here the manipulation, and then we take profit here. Now, there is another way of trading the range, and it is the breakout. So price was consolidating here, and then we got the breakout in one side. This breakout, we can also trade it. We need to make sure that it's not a false breakout and it's not a fake one, and that's what we're going to be discussing later. Now, sometime both of those, and actually a lot of the times, both of those are going to be happening at the same time, and that's the perfect combination. So we're going to have a plus sign here, and that's what we want to see: manipulation plus a breakout. That's what we need to see. And how it's going to be: price in a range, taking a low, breaking out above, right? Or something like this. You see, range, sweep, and breakout. That's what we're going to be focusing more on. But you can trade any of those phases alone, or you can trade them together. Range quarters, and in any range, there are some levels that are very, very high probability for price to react of them. Now, we're not going to take any range. In the next slide, I'll show you how we deal with, or how we identify, high probability swing points and ranges. Now, first of all, we need to have our, Fibonacci or Gantt box and follow those settings here and those levels. So 0, 1, 0.25, 0.5, 0.75. Those are the levels that we're going to be using. Now, in any range, so let's say we got this range. We have the high and another high, a low, and a lower low in this case, which was the manipulation. So our trading range is from this to this, from this high to this low, because this is our range. Now, we're going to drag our fib or Gantt box from the low to the high here, and we're going to have this retracement. So 0%, again, 25. This one actually, instead of 0, that's 100%. Okay, that's just a typo. So we have 0, 25%, 50, 75, and then 100. So the lower we go, the deeper the retracement is. Now, we got to understand that in any trading range, we can actually trade based on those levels. So this is the trading plan. Anytime price hit any level of those, 1, 2, 3, 4, 5, that's a trading opportunity. Simply, price hitting a level, it's a high probability for price to go higher. Another level, higher, and same thing. Now, what are my favorite levels? It's going to be first, the 0%. Why? Because it has the highest probability of price reaching. If price in a hurry to go up, for example, then it's not gonna go to the 75% because it's in a hurry to go higher. So it's only going to come to 0% and then going higher. That's the minimum to get the fair value, because this is where your fair value starts, is the 0% of the range. So the moment we get price hitting that level, the 0%, we can look for longs. Now 25%, very nice level, but I would really prefer the 50% over it. So 50% and the 0% are my two favorite ones, but that doesn't mean that 25% is not good, right? And 75% the same. Again, the deeper it goes, the higher reward to risk you can get and the more confident you can get, because the same logic applies to fair value gap. If price just comes to the beginning of the fair value gap and goes lower, you're not really confident unless it goes to 50% of the fair value gap. Same thing here, 50%, that's the magic number. Now, what does 100% means? Now we have, all of those retracement and prices respecting the order flow here. But what's going to happen if price goes to the 100%? That means it's a sweep of the range. And in this case, the low of the range is going to sweep the low of the range, grab some liquidity from there, and goes higher. And when this happens, a lot of time this happens when we have a fair value gap maybe below or another POI, or it just price needs to take some major liquidity. There is no major inducement here. It's going to take the low and then go higher. So we can deal with all those quarters, all those levels, and any trading opportunity occurs at any of those levels. Those are high probability ones, and we're going to see the examples and you're going to see. But before that, we need to discuss what makes this a high probability swing points or range. So remember, when price comes back to our range, the breakout swing needs to be a high probability one. And how do we identify that high probability one? But first, let's understand high probability bullish swing. Why do we need it? Because we need a higher probability of price pushing higher while retesting. And same thing here, bearish swing, a high probability one is going to give us a higher probability of price pushing lower while retesting. So the moment that it retests the range, we want it to be a higher probability for price going lower or going higher, depending if it's bearish or bullish. Now, what makes a range a high probability, or what makes a swing point? So from a low to a high, this range here, what makes it a high probability? We need to have a manipulation. In other words, very clear liquidity sweep. Now, if we have no manipulation and we have failure swing instead, that can work only if we have an SMT with another correlated pair. If you have no idea about what an SMT is, then I do have a full course on that. Now we need to have any of those, either manipulation or SMT. We also need to have displacement. Now a lot of people would just go and say, you know what, displacement is fair value gap, or fair value gap is displacement. Yes, sometimes it can happen, but sometimes you can have a displacement with no fair value gap, and sometimes you can have fair value gaps with no displacement. We can have very small fair value gaps that represent no displacement. So I need to have those two together. So we need to have a fair value gap as well as a displacement. When we have those three things, this makes our trading opportunity and trading that range automatically higher probability. You're automatically adding a higher percentage to your win rate automatically with doing nothing. And this can be applicable on any trading plan. So let's say you're just trading breakout structure, then your breakout structure range should also have those in order to consider it as a high probability one. So this can be applicable on any trading plan, not only this. So now we have the basic understanding of the ranges that we're dealing with. Let's get into the chart and show you the real deal. So looking at gold in the 4-hour time frame, and remember that this can be applicable on any time frame. You just need to use the right and the valid time frame alignment after. And also a quick disclaimer that some beginners can actually struggle with this sometimes, but with this indicator, it can help you. There are some other indicators too. I'm gonna go over some of them later, but this can be much better if you're an advanced trader and you can actually use your experience in this. You're gonna have a much higher win rate. But I'm going to explain it the easy way and you can actually adjust on it. So what's going to happen is, you see those blue zones, those are some ranges and those are some consolidation areas. Now you see sometimes we have this one and you see that it was actually a consolidation followed by a breakout, right? So from here to somewhere in here, this was kind of a consolidation. Now, how do we deal with this? We're going to take our gap box with the quarters, with the settings that I gave you earlier, 25%, 50, 75, and then 100, and this is the 0. I'm gonna take this and apply it on any consolidation zone. So you see how we had this consolidation? I mean, it's not painting the exact zone, but we can see that we had a high, had a low, we had another high here, which is lower, and then a breakout. So we can take it from the high to the low. That's our range. That's the range from this high to the low where we had the breakout. Now you see 25%, that's where price comes for the first time. Let me just drag it to the right more. So you see 25%, and just simply using 15-minute time frame here to look for an entry. So you see first reaction 25%, and you always ask yourself this question also when it comes to ranges. So we see this range, we always ask ourselves question regardless of the quarters, what are the period arrays and what are the confluences that we have here. So at the beginning and at the zero retracement, we have fair value gap here. So we think that price can actually push lower from this. At the 50%, do we have anything? Nothing. 75%, we actually have this inducement here. So we're thinking that price might actually reverse from the beginning of the range or the 75%. And those are just confluences, right? Price can do anything. And what we see here is that price actually come to the beginning of the range, give a reaction, very nice one. You could have had some profits from here, goes to 25%, again goes lower, and then 75% taking that inducement here and then pushing lower. You see how strong is it? How this range is very strong. Now this is another range here. This is also another range. If we take a look at this range here, so what you see happening is we are creating this high and then this low and then breaking above. So if we take it from here to the low of the range, which is this low, drag it to the right and then adjusting it like this, you see we had not to 25% but the 0% and then a huge trade to the upside. Then we were going lower, we had just a small retracement of the 75%, but then price goes lower. Now we have another range here where we had that high, that low, and then that breakout. And sometimes, you know, it's subjective. Some people would take this, but I really prefer this one. And you're gonna know in the future, and you're gonna learn this by experience. Sometimes it just you being subjective. So you see here, we had the breakout, and yeah, so this one, we had the breakout here. Price, you know, kind of reacted from here, but not really reacted 50%, not any of the quarters, but taking the low instead. That's a liquidity sweep here, right? So price actually disrespected everything and goes to the 100% and take the liquidity and then pushes higher. But you see after that, still respecting those levels, 50%, never close below. Now we're pushing higher. You see, again, same thing here. We had a range, which is, if you see, we had those highs here, low, another low here, and then the high was taken. So if I was to take a range, let me just take it from the high to the low. That's our range. And you see everything here is inside of it. So that's the range. We had the high and the other high, manipulation, and then breakout. If I take the quarters here from the low to the high, you can see 50% respected and then pushing lower all the way to taking the low here. That's another trading opportunity that you could have caught. Now this can be again applicable on any time frame, but I want to show you some more examples. Actually, I think I see one here, this one. To see what happened, we had this range from this low to this high, followed by a breakout here. If I take this to the right, what we see is 25%, very big reaction, another 25% and sweeping the high and then going lower. And after that, there is no reaction and no confirmation entry, most likely on the lower time frame. Now, you can also find those. You see, we had a consolidation here. The range that I can spot here is this low to this high and then the breakout, because we say that a trading range can be multiple highs and lows, and it is subjective, but sometimes it can be just one low and one high and then a breakout followed. So we can also consider this. You know, there are different ways to look at it, or you could look at the high here, but in this case, let's take this high, for example, then we can apply the other one. First of all, we had reaction of the beginning of the range and the 0%, then 50%, and then 75% big reaction. If we take it from this range to this, then it's going to be 50% exactly here, not 25% here. Now, mostly I would take this one. It just, something about experience. That's how I see the market. That's also another thing. You see, we reacted lower, we retrace lower, then we push higher, creating a breakout. That also can be a range. We have different ranges here. The thing is, we need to spot a very nice one that is followed by displacement, right? So we see this, we had a range of this high and then this low followed by displacement and a breakout to the lower side. So you can take this one, drag it to the right, and I'll just adjust it here. You see, almost 50%, and then pushing lower, disrespecting that one, but creating another range. So you see this range here had no clear breakout. We can actually, you don't need to use the indicator, but it's just for helping the beginners. But what we see here, and even with no indicators, I can see that price was actually going lower, going higher, creating failure swing, and then pushing higher aggressively with this breakout. That's a trading range that we can trust, of either from this high or this one to the low. And what do you see here is what? Price reacting first of the 0%, then the 25%, and pushing higher. That's how we trade based on ranges. And again, this can be applicable on any time frame. Now, the indicator that I'm using, you're going to go with consolidation, and it's this one, consolidation zones live. There is also another one that you can go with range detector, and it's going to be by Lux Algo. We can try this one. Now, this one is going to be more precise, drawing that exact range. So you see, we got this range, just taking our gam box here, because that one, the first one, we need to adjust on it and we need to use our experience. But this one, you see, we had a range, a breakout to the upside, then that's a range, 25%, and that's just only in the 1 minute, right? 25%, 75% going up. We also have another range here. We have another one here. So if we just take the gam box again from the high to the low, you see, 50% exactly reacting. So that just only on the 1 minute time frame. Now, this is euro dollar on the 4-hour time frame using a range detector. What do you see here is that, oh, this is a range. What we're going to do is simply take our gam box from the low of the range to the high of the range and then drag it to the right. And what you'll see happening is, so first of all, we had this 25% retracement trading opportunity, then followed by another one at the 75%. And then lastly, we took the low of the range here and then pushing higher. Same thing is to the other range. So we had also this range here, taking it from the high to the low, exactly at 50%. That's where price reacted off. So that's a sniper entry and then goes lower. Same thing here. We had this one. Price actually did not come back to this range as of now, but we have other ones. So we have this one here. You see, we take it from the low of the range to the high of the range, and that's exact 25%. And I would say that actually the Lux Algo one is much better than the first one. So I really suggest using this one. So you see, 25% exactly reacting of that level. And same thing here. We had this range and then we had a breakout to the lower side. We could have taken it from this high to this low or the range inside. But let's try this one. And just like this. So you see, this one is a bit tricky. So we had 25% reacted, then 75%, and we had a liquidity level taken here. And then finally taking the higher the range and then going lower. Also same thing here. So what I'm saying is, and let's take an example of entry just on the 15-minute time frame. So you see, that's a range of a low here. Or if we take the Lux Algo one, is going to be just like this. You see, 25%. That's also another way of looking at it, is because we had a lot of liquidity sweeps here. Is this final one, final range, because we had a high, we had a low, and we had a lot of highs and lows inside, and then a breakout that also can be looked at as a range. So you see, exactly 50% of that level. Now, how we can execute on this is either look at CISD, 3-candle pattern, creation of a fair value gap, any tab of entries, and that should be on the 15-minute time frame. And looking at the 15-minute time frame in this case, that's our 4-hour range, big one. And you can actually also identify some liquidity levels on the 15-minute. And that's something that I do called internal analysis. That's to find the real fair value gap. And I do have a full video about my theory on this. But we see we have a low here, and it's a London low that needs to be taken, and it's around the 50%. So we're really expecting that level to be taken. Playing the price action, you see at the London open, price goes lower, into the 50%, never close below it, and then we get this big candle here, creating what? A 3-candle pattern. That's a 3-candle pattern. We have candle 1, candle 2, then candle 3 closing above both. This one is very strong candle. We can actually enter at the candle closure, or we can look for retracement here. Stop loss goes below the low, and then what you can target is, you could have targeted the beginning of the range or the high here. So let's say the beginning of the range, and then play the price action. You can see that price is actually taking that level, you see, taking that level and then expanding more. So you could have taken your take profit here. That's a 3.321, a very huge one. You can apply the same as, now you can apply the same logic here on any of the ranges that we discussed earlier, because the main goal of the video is to teach you how to trade ranges other than just going to lower time frame and enter from them. So you can apply the same logic to the other examples that I went over. That's it for the video. I hope you guys like this new idea of trading. If you think that this is going to help someone, then make sure to share the video with other traders. Like the video, leave a comment. This is Mulham, and I'll see you next video.